All right, let's jump right into this explainer. Today, we are putting the absolute banking titan that is JPMorgan Chase through the ultimate valuation gauntlet. We're going to take the analytical frameworks of some of the most legendary investors in history and apply them strictly to the numbers to see what they really tell us about this stock. So to figure out if this mega bank is a buy, hold, or a sell, we're going to look at it sequentially through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. Then we'll finish up with some DCF and alternative quantitative models before giving our synthesis and final verdict.
Okay, section 1. Let's start with a snapshot of the business today and view it through the Buffett lens.
First up, the company's snapshot based on the first quarter of 2026. If we take their massive $788 billion market cap and divide it by their 2.67 billion outstanding shares, we get our current estimated stock price of roughly $294. And that gives us a really solid baseline to evaluate this absolute behemoth. I mean, we're talking about a $4.9 trillion asset powerhouse that just posted a staggering $16.5 billion in net income for a single quarter. Literally, a money printing machine. Now, when we apply Warren Buffett's quality criteria, JPM honestly passes with flying colors. Buffett wants a wide economic moat, right? Well, JPMorgan defends its turf with its famous fortress balance sheet and sheer market dominance. He wants consistent earnings, which they obviously have in spades. He's also looking for a high return on equity, and JPM boasts a stellar 19% ROE. Plus, their debt levels remain highly manageable, especially given their massive liquidity. To figure out Buffett's approximate owner earnings, the actual cash-generating power of the business, we're making the assumption here to just annualize that massive $16.5 billion first quarter net income. That gives us a jaw-dropping $66 billion in estimated annual owner earnings. For a bank, net income is actually a pretty reliable proxy for owner earnings, assuming, of course, that their loan loss provisions accurately reflect any future defaults. So, assuming Buffett wants a standard 20% margin of safety on the intrinsic value of those owner earnings, he might actually be looking to buy right near current levels. The business quality is absolutely undeniable, and at roughly a 12x multiple on those owner earnings, you could argue it's fairly priced for a wonderful company. But let's see what the other legends think, shall we? Moving right along to section 2, let's look through the Peter Lynch lens to see if we've got growth at a reasonable price. Lynch would instantly categorize JPMorgan as a stalwart. These are those massive, established beasts of the market. Now, they aren't going to double your money overnight, but they offer moderate growth and really reliable protection during recessions. In fact, JPM just announced they intend to hike their quarterly dividends by 10% to $1.65 per share, completely reinforcing that stalwart status. Now, Lynch loves using the PEG ratio to sniff out value, which is just price to earnings divided by the growth rate. Using an annualized earnings per share of $23.76, we calculate a PE of roughly 12.4. And if we assume a fairly conservative 10% future growth rate based on their historical compound annual growth, we get a solid PG ratio of 1.24. In Lynch's playbook, anything hovering near 1.0 is considered pretty fairly valued. Lynch also really loves a strong balance sheet to protect against downside risk. And man, this perfectly illustrates why JPM is so resilient. They've got a 14.3% common equity tier 1 capital ratio, which is essentially a super strict measure of a bank's core financial strength, well above the minimums. Add in $1.5 trillion in high-quality liquid assets and unencumbered securities, yeah. From a Peter Lynch perspective, checking off the stalwart category, a fair peg, and that massive liquidity, JPM definitely earns a firm hold or accumulation rating.
All right, section 3. We're putting on the Benjamin Graham lens for some strict value math.
Now, Graham is a stickler. He requires you to check every single box for the defensive investor, and JPM absolutely crushes the first 5 steps. It's got the massive $4.9 trillion size, incredibly strong financials, rock-solid earning stability, a flawless long-term dividend record, and a moderate PE of 12.4. But it actually fails the final step. Graham insists on a price-to-book ratio under 1.5, and JPM is currently trading at a PB of 2.29, so strike one there. Let's actually look at Graham's strict intrinsic value formula in action. It sounds complex, but it's really just rigid math. We take that $23.76 annualized earnings per share, multiply it by the actual $128.38 book value per share from the first quarter, and then multiply by Graham's 22.5 base multiplier. Take the square root of all that, and we get a strict intrinsic value of $261.97 per share.
So what does this actually mean for us? Well, because the current price of roughly $294 is higher than that intrinsic value of $261.97, we're looking at a negative margin of safety here. Graham was a notorious bargain hunter, right? He honestly wouldn't touch this stock today. He'd likely wait for a 25% margin of safety, meaning the price would literally have to drop to a theoretical buy trigger of around $196 before he'd even give it a second look. Moving on to Section 4, let's look at some alternative models like DCF and DDM valuations.
To build our base case discounted cash flow model, we're projecting out 5 years. Now, since the earnings supplement doesn't just hand us future cash flows, we're using that $66 billion in annualized owner earnings as our base. We're assuming a standard 10% weighted average cost of capital, which is basically the required return for a major bank, a 3% free cash flow growth rate, and a really modest 2% perpetual terminal growth rate. When we discount all of that back to the present, it gives us a fair value of around $310 per share.
But as analysts, we know these models are highly sensitive to the inputs. This sensitivity table shows that if macroeconomic conditions shift our interest rates and alter that 10% cost of capital, the fair value swings pretty wildly. If we push WACC up to 11%, fair value drops to $270. Lower it to 9% with higher terminal growth, it swings up over $350. Honestly, at $294, it looks like the market is pricing in almost our exact base case scenario.
When we apply some alternative models, things get even more interesting. A strict dividend discount model, using that newly planned $6.60 annualized dividend and an 8% cost of equity, yields a super low $132 fair value. But remember, banks retain a ton of earnings, so DDM models often severely underprice them. Conversely, if we apply a historical 2.0x price-to-book multiple to their $128.38 book value, we get a much more realistic fair value of $256.
And finally, Section 5, Synthesis and Final Verdict. Time for our final analyst call. Let's bring the jury back into the room and look at all our models side by side. What we see here is a really tight cluster of fair value estimates. Buffett's lens and our DCF model point to a fair value right around $300 to $310, but Graham's strict math and the historical book value multiples drag it down to that $256 to $262 range. Generally speaking, these estimates are all hovering right around or just slightly below the current $294 trading price. The main takeaway you should grab from this is that the fundamentals are truly phenomenal. I mean, JPM boasts a staggering 23% return on tangible common equity, a huge measure of bank profitability, plus an authorized $50 billion share repurchase program. That's massive. But we have to acknowledge the risks. Their recent stress test projections show their capital ratio could drop to 12.4% under severely adverse conditions, which really highlights their ultimate dependency on macroeconomic stability. So, blending all of our insights together, JPMorgan is a hold for now. The old adage rings true. You don't sell a fortress. However, at $294, most of the upside is already priced in. A Graham-style value investor would definitely wait for a market dip closer to $260 before buying, while a Buffett investor might actually be comfortable buying incrementally today. Knowing all the math we just went through, what is your personal trigger price to buy this banking giant?